Welcome to the Crypto Compliance Podcast by Gegna.
Hi, this is Crypto Compliance. Welcome all crypto and compliance fans. I'm Paweł Kuskowski. I'm here with Dimitris Psarrakis. Dimitrus, hi, how are you?
All good. Many greetings from Brussels.
So, Dimitrus, I'm very pleased to have you here. For many reasons, I wanted to invite you for a long time already for this podcast. We finally made it. Your experience in the field of regulations is so extensive that it's definitely exciting for me to talk to you. But let me briefly introduce you. So you are co-founder and director of Valueverse. You also a board member for Global Blockchain Business Council. So it's all circulating around regulations. You've been a member of European Parliament, correct? For 7 years.
Economist of the European Parliament.
Economist, okay. And your focus was for a long time to talk about, this blockchain, crypto. You wrote 2 books on this intermediation economics and the impact of blockchain in market and policies, and one on the financing and financial reporting for the European SMEs in the area of the CMU and the new IFRS. So all very exciting topics. But the topic which I wanted to start with you is something that we discussed right before this call. So the economical impact of regulations in the area of crypto, stablecoins, tokenization of assets. What's your view?
Well, when we are regulating something, we are regulating effectively 3 things. A business model, or how a company promises to generate value. An operational model, or how a company wants to transfer value. And a profitability model, how a company plans to capture the value or part of the value it creates. So if you think about any activity in the space of the prudential, the money laundering, even the tax implications of the story is all about these 3 aspects. And this, by the very beginning, allows us to organize every regulation around these 3 main areas. And in the area of crypto specifically, this was the number 1 priority of the European Union day 1, because we had the experience of Libra. And when the Libra team came to visit us in the European Commission and the European Parliament, they were very good in explaining us how they are going to generate value. They were very good in explaining us how they would deliver value. But when the European Commission, the European Parliament, and other regulatory authorities asked them, okay, and how you are going to make money out of it, they didn't know how to answer the question. This was a major red flag. This immediately made us think that they are going to monetize our transaction data. So when we drafted the initial drafts of MiCA afterwards, the number 1 priority for us was to focus especially on how these projects make money. And the outcome was, first, instead of focusing only on the crypto asset service providers, was also to speak about stablecoin service providers or stablecoin issuers and how they can make money in 2 different aspects. This is what explains why we have 2 stablecoins aspects in MiCA. The asset reference tokens that are stablecoins mainly operating as store of value, and payment stablecoins, the e-money tokens, that are mainly tokens issued for payment and settlement purposes.
Yeah. Do you think the moment of truth for MiCA, right? And do you think the MiCA is actually good for the market, or it's actually bad for the market?
Sure. MiCA is on the way to start being implemented. We discussed long about MiCA in the last 3 years. And by the 30th of June, Titles 3 and 4 of MiCA are enacted. And by the 31st of December, the rest of MiCA is going to be in place as well. The technical standards are on the way to be finalized. At this stage, we are talking about the market abuse aspects of MiCA. Now, who is going to be benefited and who not? Obviously, we have a macro impact by the introduction of this regulation. Very important comment before delving into this topic. Every regulation is about market structuring. This is very, very important. Market structuring means who is entitled to offer services in a specific space, how big the market is expected to be, and who is getting be favored out of this process. This determines the level of competitiveness, meaning are we going to have a perfect competition? Are we going to have an oligopolistic competition? Are we going to have monopolistic competition? This is the one dimension of the story. The other dimension of the story is related to the consumers. Do the consumers feel more comfortable to play with these brand new instruments because they feel that if something goes bad, there is regulatory certainty and legal clarity to deal with their problems? So, starting from the second point, yes, the consumer should be a little bit less concerned about this area because the regulation regulates exactly the conduct of crypto asset service providers and the issuers of tokens. So if you are a retail customer or if you are an institutional player wanting to get into this space, you feel much more comfortable to crowd your capital in and help the market grow by using these instruments. The question number 2 is where this new capital is going to be channeled. Is it going to be channeled to many players, to few players, or to whom? Newcomers, old players. So it's still very early to make an educated guess, but if I share my views, if I can share my views with you, I would suspect that network effects apply in the crypto industry. This means 2 things. First, I do not expect a concentration. I do not expect the distribution of the pie of the demand for stable coins being very widespread. I see that in the end of the day, the market is going to be concentrated to only very few players, 5, 6 stable coins. You don't need more in a market of 450 million people. And this applies also to the idea of crypto asset service providers. The vast majority, the 80-90% of the activity of crypto asset service providers is going to be concentrated in only 5 players. I don't think that it's going to be bigger. Now, talking about crypto asset services, we have a constellation of crypto asset services. I think they are 10 or 11 in MiCA. Of this pie of crypto asset services, I see banks stepping in and claiming some of the pie. Yeah. Banks in the European Union are 15,000 banks, and all of them are designed to offer custody. Why not to enter into the space of custody? And my valuers ran a survey with some of the major European banks, the 82% of which said that they are already exploring or they are implementing a project related to e-money tokens and custody. I see banks claiming a part of the pie. Now, who is favored from this process? If you look at the list of requirements for authorization and licensing for the issuance of tokens, for example, you see that credit institutions already have in place the 80% of what is required in order to perform operations in this space. For the rest of the world, they have to comply with everything. Now, if you are an e-money institution, which means second-rate credit institution, still you have a small advantage. So for the players who are considered as newcomers, disruptors, I see a strong tendency either to become banks or credit institutions. And we see already in the case of some of the major stable coins struggling to articulate a business model that is effectively profitable.
Yeah.
So if they want to generate the income they generate from what they are already doing, they cannot have it in Europe because the compliance requirements dictate them to allocate the proceeds of the capital they have to issue a token into very low credit risk, very low market risk, very low concentration risk assets. Which means that if you want to operate in this space, you cannot have a model of a narrow bank. Like, for example, major stablecoin providers are already operating with. You need to offer other services. This is something that they don't want to get in. And if you ask me to put the money in the front line and calculate who is going to dominate this, if the major stablecoin in the world has a capitalization of 8 billion, and 8 billion is the first 10 minutes of trading of Deutsche Bank, imagine Deutsche Bank introducing an e-money token. Who is going to get the market in 24 hours? So this is my view.
Was it design, you think, MiCA? I mean, I remember we both work on INATBA kind of working group, right, to discuss MiCA implementation and how we can do this in the best way possible. I think nobody took into consideration so far that the winners will be existing credit institution banks, e-money, institution at the moment. I think, at the moment, if you're holding e-money license, you are a big winner and you can sell it in like 5 minutes, right, on the market. Everyone wants to buy e-money institution. So do you think, MiCA was designed like this, or to lower the risk, or to maintain the banking system in Europe profitable, and to kind of take over the whole crypto market and start profiting from this? Or is it far too stretched idea?
I think, Paweł, this is the moment that I will entertain you and your audience, because I will start replying to your question from the end. Obviously, MiCA alerted everybody in the European institutions, and the design they favored was a design that every issuer of stablecoin would be regulated within the framework of the existing banking sector. So payment services is something that can be only developed within the existing banking framework. Now, if something is a financial instrument related, then again, we made exactly the same decision. Financial tokens could be dealt within the framework of the existing financial institutions.
Yeah.
For everything else, utility tokens, NFTs, and so on and so forth, we could make a dedicated regime. And for the crypto asset service providers, we didn't say, okay, if you want to be a crypto asset service provider, you need to have a MiFID license. We said, okay, we are going to create a lighter regime for you, which means you need to comply with, subject to what kind of services you offer, you need to comply with MiCA and with just 11 more regulations. Very important to mention at this point that when we are talking about issuing a token you do not only comply with MiCA, you need to comply with 12, 13 regulations. And if you are a crypto asset service provider, you need to comply with at least 12 regulations. And if you also offer derivatives, you need to comply with 26 regulations. So already this gives a signal of the regulatory burden. Now, why like that? In the beginning, when we drafted the blockchain resolution of the European Parliament, I had the honor to be the draftsperson of this text that created the framework of the blockchain strategy of the European Union. I had one thing in my mind. Being a Greek, I have suffered a lot because the Greek taxpayer had to bail out German and French banks.
Yeah.
So I wanted somehow to mitigate the risk of the too big to fail by creating a space of alternative finance. However, it turns in the early stages of the development of the market that these network effects we described in the previous part of our conversation also applies to crypto asset service providers. And what we effectively did was to replace the, forgive my French, old bastards with new ones. Because in the end of the day, you have a concentration of the market to 5 to 10 major crypto asset service providers and 5 max issuers of tokens. So effectively, nothing has changed.
When you
Now,
talk
if you
about
ask-
when you talk about token issuers, what exactly you mean? Platforms where the tokens will be launched, or?
Yes, I mean, for example, offerors, issuers and offerors of major stablecoins.
Okay. Right.
So how many of them you see out there? Obviously, we are talking about thousands and thousands of tokens, but the concentration of the market, the 8%, is concentrated between 6 or 7 issuers, right? Same thing about the crypto asset service providers. So what kind of democratization of finance we are talking about? Nothing. So if they are so big, they can comply as effectively as every other bank.
Exactly.
Right? So was it designed like that from the very beginning? Yes. It was deliberately designed like that because the concentration risk could have significant systemic impact. And if you go to my colleagues of DG FISMA and you ask them, do you like to see an emerging crypto asset service provider be regulated exactly as Deutsche Bank does in order to sleep quietly in the night? I will say, of course. Are you crazy? It was by design like that and for a very good reason.
And what was the reason? To protect the market.
I just told you, the concentration risk, the network effects of the economics of this industry are not different from the platform effects, which means that the winner wins everything. Now, how much fragmentation I expect to see in the market? We don't see in the case of the European market huge concentration because we have 15,000 banks, and out of which I don't know how many systemic banks we have directly regulated by ECB.
Yeah.
This fragmentation exists exactly because we have 27 member states, right? So the platform effects of the crypto asset service providers, I expect that is going to be in the vicinity of, let's say, 1,000 providers, with 5 taking everything, and some smaller providers taking a very, very small part of the market, mainly in geographic concentrations or community concentrations. And all the rest is going to be shared between major and minor banks.
So banks would be, in your opinion, the 5 who are the winners in this games. It's not VASPs who are crypto born, let's say, challengers to the current, let's say, established institutions?
So this is the one dimension. The second dimension is related to the exchange.
Right.
The exchange of value, not about the issuance of value and the custody of value. The exchange of value, the main competitors of the existing London stock exchanges, Deutsche Börse, and so on and so forth, are crypto asset service providers who work 24/7, and they offer really market agile service. That the moment that these major crypto asset service providers, the exchanges mainly, realize that MiCA is actually a restriction for them, so they need to go to the MiFID world to offer financial services, I think that these guys are going to disrupt the existing dominant exchanges of value across Europe, because they offer a kind of service which is of completely different quality. It's 24/7, super fast, super efficient, and they are not restricted by the book policies that we now see in place in the traditional stock exchanges, the bid-ask constraint. The moment you have the possibility to create liquidity pools with staking, you get into a completely different liquidity environment. With the existing dominant paradigm, we have only one concept of liquidity: bid, ask. Now, to calculate liquidity in this environment, we calculate effectively three things: the cost of liquidity, how big is the spread between bid and ask; the depth of the liquidity, how big is the list of bid and ask to make market matching; and the speed of the liquidity, how much time it takes to match a transaction. Imagine how things change in an environment of liquidity pools, that the concept of order book, becomes irrelevant. Now, is it regulatory compliant to have liquidity pools? So I made a dedicated research exactly on this, because if we're talking about tokenization of value, we are talking about the liquidity benefits you can generate out of the token, right? So liquidity is number one prerequisite here. Yeah. So I made the research. MiFID does not prevent us from having alternatives from bid and ask, contrary to the United States, that they require book arrangements. So MiFID is not a problem for us. Second, the technical standards of MiFID. MiFID is 160 pages. We have 1,008 pages of technical standards. Do we have any restriction in MiFID? No, we don't. In the design of the DLT Pilot Regime, which, by the way, was my last regulation before leaving the parliament, do we have any restrictions on the structure of the liquidity provision? No, we don't. What we have is the communication of ESMA regarding the implementation of the DLT Pilot Regime coming last November, which asked from the ones who want to actually participate in the process of the DLT Pilot Regime. You remember the fiasco. They were explicitly asked not to have a liquidity structure alternative to bid and ask. Which means, come on, if you don't explore these possibilities in a sandbox, in a protected environment, where do you expect actually to explore these actual benefits of the tokenization of value? So, yep. I think that for some aspects, banks will win. For some other aspects, exchanges will prevail. Or the Deutsche Börse and the London Stock Exchange will become VASPs themselves.
So you think, I mean, like just I know that we shouldn't be mentioning this name, right? But Binance, with creation of the liquidity pools, liquidity pods, it's almost like it's very. I've been studying this for some time as well. It actually looks like it's very, very interesting idea, right? It's actually really, and the staking. I hear from many people who are in the business of crypto and was also in the let's say, coming from the mathematic or economical angle, is that staking is one of the biggest innovation in crypto, right? Staking is actually where, the innovation happens, and it's one of the most promising thing. Why do you think? Why do you say that? Bid and ask, an alternative to bid and ask and staking. Why it's such a big thing?
I think that the possibility
lower costs, or speed, or all of this.
Okay. The benefits. First, let me agree with you on this analysis. I believe that the possibility of staking is more important than the possibilities coming from tokenization itself, because it forces us to think outside of the box and to explore alternative ways to reduce the cost of liquidity and the liquidity risk. And by the side of it, the counterparty risk, because much of the clearing and settlement process that was put in place in the financial value chain was put in place exactly because we wanted to ensure market integrity in different layers of the finance value chain: trading, clearing, and settlement, where we have it in 3 different places, because we couldn't in the trading and liquidity pools. Practically, you merge the possibility of having the trading and clearing in one place, and with the possibility of having a tokenized fund, not necessarily a CBDC, tokenized fund, also allows the settlement to take place automatically on the same chain, immediately, in full transparency. This changes completely the value proposition of finance. Now, where the benefit comes from an economic point of view? First of all, you get rid day one from 60 cents on the plain vanilla fees you need to pay to the clearinghouse. So if you have an Apple stock and you want to exchange it, transaction cost for the clearinghouse only is 60 cents. The moment this becomes a little bit more exotic and you have to trade an exotic option, the clearing function costs up to 10 to 12 euros. So if you are Deutsche Bank and you have a huge volume of transactions in this space, you immediately make a significant amount of your money by getting rid of the clearinghouse. The settlement, which is the moment that you actually exchange the security with the money and put it in the balance sheets of the respective transaction counter, also is going to get some money, but doing it on chain saves a lot of money. But the main result of the benefit is not how you drive the nice axis, X and Y axis. The demand curve looks like that, and the cost curve looks like that, okay? And the average cost curve in the long run, by necessity, is a straight line. Focusing on this kind of transaction benefits, it's all about driving the cost curve down. The actual benefit of tokenization comes from the capability to generate network and liquidity effects that effectively make these available investment opportunities accessible to people who now are afraid to get into the market. This effectively is not about driving the cost curve down, but shifting the demand curve to the right. And the notional triangle between the cost curve and the demand curve is how much you expand the value space of the asset. This is the very important aspect that nobody talks about, only valuers, on this point of actually deciding whether to tokenize something or not. This is the one thing. And this one thing does not have implications in the unit of the asset you are trading. It also has implications on the way you structure portfolios, the way you rebalance your portfolios, the cost of rebalancing. The fractionalization of the asset allows you to hold in one token the entire market. So effectively, you have an index in a token. And exactly because you can create your own indices within the space of one token, you actually have first time the possibility to construct precision ETFs and precision indices that 100% match the risk appetite and the wealth appetite of the investor. This never happened before. And all this with minimum liquidity risk, because the liquidity is pooled, not placed in a book. So this is the macro effect, the macro financial effect of the kind of financial paradigm we are talking about. And imagine now that on top of this, there is a layer of smart assets, which is tokenization, plus smart contracts, plus oracles, plus machine learning.
Yeah.
What means smart asset in the end of the day? Information sensitive and semantics sensitive assets. It's not that I get a bond and I live with this bond for the rest of my life. I have the bond matched with an equity, and I have a completely different projection of cash flows and a completely different projection of the discount factor. So we have a completely different asset matched by a blend of the tokens. And because it's information sensitive, you can put in information that absorbs all the benefits you need from the macroeconomic environment you are operating. Now, how this affects the operations of a bank. If you are a bank, you want smart assets. Do you want to have smart liabilities? Nobody wants to have smart liabilities. So you want to have liabilities that by using tokenization, smart contracts, oracles, and machine learning, you actually reverse engineer the process and you suffocate information sensitivities from your liability side, essentially creating a balance sheet where you have smart assets and dumb liabilities. This immediately liberates regulated capital per capital required CRD4 or Basel requirements of capital. These are liberated to be used in other profitable and capital efficient allocations. This is what we are talking about. And this is something that nobody talks about. And I'm very sad because people really don't get it. If in the end of the day, especially in this geopolitical environment, very difficult geopolitical environment, you want to have a more efficient and more competitive financial system, you need to understand these dynamics and design a competitive financial system based on the blending between blockchain and AI. Otherwise, Neither allocation efficiencies are going to be there, nor risk allocation efficiencies are going to be there, nor sustainable investment opportunities for the pension funds of the people. Because I don't know if you have noticed, the price of equity is so high, which means that the returns are so low. The inflationary environment is so high, which erodes the value from fixed income securities, from bonds.
Yeah.
And the perception of the people of the market is that the expected returns in average are going to be lower, and the realization of profits of the investments are going to be much more difficult. So how we are going to match the liabilities of a pension fund? We need smarter assets. It's a social problem. It's not about making money. And instead of having 100,000 euros income per year to have 120, it's about sustaining the infrastructure of everything.
Was this discussed with the wider group? How many people is aware of what you just said? Because it all makes sense. And thinking about this, from top of my head on MiCA, you're correct. So how many people actually know this?
Well,
how many people?
Okay, very practical. I don't think that I teach this class of DLT financial infrastructures at the Cambridge Center of Alternative Finance.
Okay.
Nobody else teaches this. From September on, I will start making research on this topic at Wharton Business School. So I'm leaving from Europe to go to the United States.
Okay.
I don't think anyone does this research yet. From the side of the policymakers, I know only one person who understands and is very much familiar with that from the European Commission is Peter Kerstens. Other than these very, very few people, 5 people, 10 people, nobody has done evidence-based research on this part. Everybody speaks about the promise of blockchain. Everybody speaks about liquidity benefits. Okay, how much? And we are moving from the proof of concept to the proof of value.
Right.
So we are moving from the enthusiasm of the IT department of a financial institution to the board members who ask the enthusiastic innovation departments the terrible question: how much? How much money we are going to make, how much risk we take into our balance sheet. And nobody makes this calculation. Nobody.
So but it's going to happen to, when we talk about the liquidity pool, would this be created for the existing assets, instruments, or let's say for crypto primarily?
Well, does this question actually make sense? If we tokenize something, why I ask? Obviously makes sense. But what I want to say is that in the end of the day, this dichotomy that separates traditional finance and new crypto finance, as well as this dichotomy that separates traditional assets with new assets, this becomes less and less relevant. So in the end of the day, you are going to have a constellation of assets that you can trade and form portfolios around it, and a constellation of services that are not really isolated from each other.
Okay, so in this way, I see this as well. Like the all, let's say, traditional financial instrument and crypto is becoming, even in terms of when you are, raising capital, right? It's almost like becoming irrelevant if this is a token or equity for the crypto first VCs. So I see this from this angle, right? They look for, how the staking is structured, how we, structure liquidity, and this is becoming, and actually, I have some very interesting team it's called Zerbas. I don't know if you heard about the guys. German, team. I think the guys are either from physics and mathematics, and they build the analytics on behavioral, let's say, analysis of, let's say, tokens, right? But the data they are collecting, they say, these are the parameters which you are looking, like, how you are structuring the liquidity pool. Liquidity pool is first, right? Liquidity per pool right now is like the main indicator. How much is there in the liquidity pool? And they say that meme coins actually are structured in the way that there's a lot of capital in the liquidity pool. So it's it's not risky asset, because there is something that you can see immediately and you can assess the risk connected with these assets live in the live scenario, right? So it doesn't matter what kind of asset it is. It's a matter of, how much liquidity there is to support this project, right? So I think this is one of the indication what you are saying, but we're going to see this kind of, liquidity pools when then it will be tap on. When you start new projects, you immediately kind of, go, and there's people waiting to provide you liquidity, right? And this is the way we can, and then, the staking is obvious because you hold the liquidity and you support the project, almost with your liquidity, so with your money. So it's becoming irrelevant whether this is shares, which are completely liquid, of, startups. If you are a startup and if you think that you have 1 billion and you suddenly want to cash out, you realize that it's not more than 50 million, right, on the market, because nobody wants to buy it because there's no liquidity. So, it's very interesting what you said. What about stable coins? I mean, do you see, the stable coins? Because in so many ways now, stablecoin is the only promise, in my opinion, of crypto, right? Where you will see that it's becoming more and more, in comparison with Visa, MasterCard. It's very similar numbers and growing for crypto. But what you said is exactly right. When we have Deutsche Bank, it's actually, 8 minutes of trading. What do you think, stable coins? I mean, are they going to play big role? Or, it's going to be segue from traditional finance to crypto? Like, what's your view on this?
To continue a little bit on the previous part, you made a very interesting comment about the aspects of liquidity. Liquidity is not it's the holy grail, true. But if you are a player that holds a wealth of different assets, you don't really care about the liquidity as much as the spot trader cares, because you buy something and you hold it. So liquidity has a completely different impact for the big players, make them big volumes. What gives them an extra benefit is the possibility of access that comes from the fractionalization of an asset and from the linking of the tokenized asset with the reporting of the actual changes in the portfolio value in real time. A work that usually the present fund structures takes 20 days to do for major wealth funds. They need to have 50 people and 3 weeks in order to report the actual value of the portfolio from the general partners to the limited partners. And imagine that on top of this, you can have sensitivities linked with the token. For example, if you run the most illiquid part of the story, which is a real estate asset, and you have a real estate asset, and this is a smart house, let's say, that generates profitability out of the adaptation of the Internet of Things infrastructure you put over there. This has an immediate impact on the cash flows. This is reported automatically through an Oracle with your Excel, and in 20 seconds, you send a report of the actual value of the property to the holder, the owner of the property. Imagine this in a large scale for any liquid asset. So this is a second aspect, the information flow part, which is not liquidity, but it's very, very important in informing people about the actual values of portfolio holdings. This is the one thing. Now, Going to your question about stablecoins.
Stablecoins.
I suspect you mean payment stablecoins, right? Because in the part of the European Union, we have two types of stablecoins. For the payment stablecoins, this is exactly true what you say, because exactly the idea of the actual benefit of tokenization of other assets is not developed in the economic mentality of the people. The more we understand tokenization, the less significant the role of the stablecoins will be in our narratives. Now, in the value chain, you need settlement of transactions.
Yeah.
And you need settlement of transactions on chain. I don't know if I will ever go to the bakery to pay with a stablecoin, but I know that the settlement of my financial transactions has to be on chain and fast. And if I can associate my future settlement processes with infrastructures, this makes a lot of sense to me, because you need programmable money with stable value. And we can speak about payments in three layers. Payments between Paweł and Dimitris. We don't really need a stable coin to transfer value. We can, why not? But we have cheap alternatives for that. So adoption, I don't expect to be very fast there. We have another layer, which is exchange of value between Paweł and the machine. Again, we have already in place an infrastructure for that, but the smart contracts element of future payments can help a lot in the programmability of the payments between humans and machines of every kind. The place that I really see a lot of value is in the machine-to-machine payments, in an Internet of Things dense environment. My self-driven car goes to the gas station, fills gasoline, and comes back and pays there. Or my very smart refrigerator has a link with Carrefour, the supermarket. It checks how much milk I have, so it sends a direct order when I reach a limit and makes the payment automatically between the fridge and the cashier desk of the supermarket. I see a lot of benefits there. And from the same token, I speak exactly about this thing about financial transactions. Because effectively, the rebalancing of your portfolio is not going to be made by you, but by algorithmic machines. So the buying and selling part of a transaction on chain can only be settled on chain from programmable money. So the moment we will stop talking about stablecoins and we will focus on other kind of tokens, it's the moment that the performance of the stablecoins is so down, so standard, that nobody's going to care about it. Like the moment you get into your house and you switch on the light.
There's going to be settlement layer between machines, right?
Yep. But you are right. At the very early stage we are talking right now, the stage that we don't really get what tokenization means, stablecoins is the most appropriate narrative to discuss about, because over there, the economic promise and the economic value is so apparent that we know what we ask for.
It's easy to comprehend. It's easy to explain. It's easy to kind of, say this is this, basically easy comparison. So in the current, geopolitical environment, when you see the world, right, and European Union versus US versus Dubai versus Singapore, where do you think how the, let's say, divisions are coming, and who is currently winning, and what's going to be, you think, that the jurisdiction to come?
I think that in the era of uncertainty, the winner is the one who provided the regulatory framework. In an imaginary world where the regulatory framework is everywhere, the most innovative forces and the more entrepreneurial mentalities will prevail. This very basically means that Americans will dominate the market in the end of the day because they are much more entrepreneurial than what we are in the European Union. English are going to play a significant role of that. You are going to have some significant technological breakthroughs in Europe because in Europe we have very good technology capabilities and huge incapacity to commercialize it. So we are going to have innovations pumping up in the European Union, in Poland, in Germany, in Austria, you name it. They will reach a point that they cannot scale more in Europe. So the smart Americans will come up with the Sequoias and the A16Z to buy out our wonderful European companies and make them American and make money out of them, squeeze them. Now, how much of creativity I expect to see in the ecosystem of the Middle East? Middle East is a provider of capital, net provider of capital. They can develop nothing over there. The best thing they can do is to invest their money in Europe and America. I don't really care about the regulatory frameworks down there. Nobody's going to do business there unless they are somebody who cannot get license anywhere else. Now, the question is how these things are going to evolve in Asia. Asia is not one place. We're talking about Asias. India is expected to have its own trajectory, the success of which is related to the level of immersion that the Indian ecosystem will have with the rest of the global value chain, because we are talking a massive population, massive concentration of human capital, number one, and technological capabilities, number two. Then you have local players in Asia, namely South Korea, Singapore, and Hong Kong. They are not global markets. They have some global access for specific products, but mainly their role is going to be local in this area down there. And the big elephant in the room is what China is going to do. And I'm super confident that despite the fact that the human capital in China is tremendous, the human capital that is going to flourish in this country is the human capital that will escape from the country. Effectively, I don't see any potential in this massive country. Not at all. I know it sounds strange. Everybody looks at their significant breakthroughs in CBDCs, in artificial intelligence, what they claim they can do in quantum computing. Irrelevant. I don't see any potential over there. I strongly recommend to our Chinese friends to concentrate on the electrifying their villages in Tibet. Let the global leadership to somebody who is educated to do that. And the last but not least is our friends in Russia. Russia, they don't know yet, but they are the Ukraine between Europe and China. So as long as they still have time to link their value chains with ours and use their very limited and minimal human capital they have with the rest of the Western world, it's going to be beneficial to them. Otherwise, it's going to be a dead territory between China and Europe.
Strong words, I would say. But I agree. And yeah, I think
there is no more Russophile than me in European Union. I'm married to a Russian woman. I have many good friends in Russia. I'm Greek, making me immediately very friendly to Russian, Orthodox. But politics is politics, and economics carry a Newtonian gravity that nobody can ignore. The only way for Russia to survive in the next 20 years is through the permission and the space that Europe and America will allow them. Chinese will never allow them to breathe.
Yeah, I think this is very, very interesting point. Very controversial, I would say. At the end of this podcast, but I would say yes, and I completely agree with kind of the picture of innovation, especially in crypto. I don't know, maybe artificial intelligence, we're not going to be able to compete with the US, but that's why I hope so much for crypto to be the, let's say, Europe to be the center for innovation for crypto, and then maybe once it's actually growing, it's moving to the US, and it's a kind of fair game at the end, because you go for valuation at the end, but you still have very good ties with Europe, right? So I think it's very, very interesting point of view. Dimitris, thank you very much for your time. It was excellent.
Thank you for having me.
Crypto Compliance, brought to you by Gate Knox.